Welcome to Alpha Recap, your post-market breakdown from stockalpha.ai. I'm glad you're with us. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. Excited to dig into what was a pretty busy day in the markets.
Totally. Let's jump right in. To start, the big macro headline, the 30-year Treasury yield moved notably today. And the number that really caught our eye? It climbed above 5.19%, the highest since before 2008.
Yeah, that was huge. That one data point reverberated across a lot of sectors. Analysts have been saying rising long-term yields compress the present value of future cash flows. So growth and long-duration tech names were the ones feeling the pinch.
So what really stands out here is how one move in yields can change risk premia for the whole market.
Exactly. When discount rates go up, the math just doesn't favor companies with earnings way out in the future. Multiples can shrink even if nothing else changes in a company's business.
Right. And that tied directly into the Fed minutes released today, which flagged that firms are passing higher energy costs on to customers.
That was a key line. If companies stop absorbing those cost increases and instead raise prices, that can keep headline inflation stickier. And that changes the expected path for central bank policy.
So, higher yields plus pass-through equals a tougher backdrop for growth names. Not a great day for long-duration tech generally.
Yeah, that tracks.
But the tape wasn't one way. There were some idiosyncratic winners and interesting sector moves. For example, HSBC raised its price target on Nvidia ahead of second quarter results.
And on top of that, Anthropic made a headline-grabbing hire, bringing in Andrej Karpathy, a prominent AI technical leader. That boosts technical credibility for Anthropic and sent positive signals across the AI ecosystem.
Hold on, say that again. Karpathy to Anthropic?
Yep, Andrej Karpathy moved over to Anthropic. That type of hire matters for investor sentiment. It was one of those stories that made people sit up despite the macro noise.
But there was also a legal angle, right? Anthropic is fighting a government blacklist in court.
Right, so you get this dual narrative. Technical progress and talent concentration on the one hand, and regulatory and counterparty risk on the other. Analysts pointed out both sides today.
Okay, quick reactions. Notable winners and losers?
Granite Construction traded near about $141, reflecting strength in infrastructure exposure. Home Depot reported comparable sales ticket growth around 6.75%, which suggests pricing power even as traffic softened.
And on the downside?
Payments and telecom names lagged. Evertech was about $23.39 after a 6-month slide of roughly 17.4%, versus the S&P's about 11.5% gain. AT&T finished the period around $24.69, down about 3% over 6 months.
Ouch. And there were some extreme moves too, like a mid-cap or micro-cap liquidity event.
Yes. One small name plunged roughly 42% down to 38 cents, which underscores how headline-driven and idiosyncratic volatility can be in pockets of the market.
Short reaction, big move. Not what anyone expected.
Nope.
Let's unpack the oil and energy thread, because that's central to the Fed minutes and inflation pass-through discussion.
Deutsche Bank's perspective brought some nuance. They argued that the Iran-related episode pushing oil higher lacked the 3 historical ingredients that typically caused broad market oil shocks. Things like sustained supply disruption, big inventory draws, and policy responses that materially altered cost of capital.
So the takeaway there is that today's oil move might be strong, but not necessarily on the path to a 70s-style energy shock.
Right. Deutsche Bank suggested it could be more muted, but others highlighted that oil strength was already impacting equities. For example, some tech and enterprise names slid on macro pressure tied to energy and yields.
Makes sense. So conditional risk. If inventories, OPEC behavior, or shipping disruptions escalate, that could change the story.
Exactly. It's about watching those triggers. For now, analysts diverged on whether this episode would broaden into a sustained macro threat.
Let's pause for a moment. One-liner reactions?
Yields mattered most today.
AI headlines cut both ways.
Sector dispersion stayed high.
Great. Now, explain in plain language how rising long-term yields hurt growth stocks.
Sure. Think of a company's future profits like a string of cash arriving over many years. To compare that to today's dollar, you discount them back using a rate. When the long-term yield goes up, that discount rate goes up. So those future dollars are worth less today. The farther out the cash, the bigger the hit. That's why high-growth firms, whose value depends a lot on distant earnings, saw their multiples tighten.
Nice and clear. And for fixed income folks, what changed?
The 30-year yield repricing altered the income landscape. Longer duration bonds became more attractive in yield terms, but also brought bigger duration risk if yields pushed even higher. Bond traders will be watching real yields and inflation break-evens to figure out whether the move reflects higher real rates or just inflation expectations.
So, why should a value or cyclical investor care?
Because energy and industrials see mixed effects. Higher oil helps energy producers and some infrastructure names, like Granite Construction, while consumer-facing businesses face a trade-off. Higher ticket sizes, but potentially softer traffic. Home Depot is a nice example of ticket-driven resilience.
Let's talk AI for a minute. Beyond the Karpathy hire and the Nvidia upgrade, what broader themes did analysts flag?
Analysts noted two competing forces. On one side, high-profile talent moves and analyst upgrades suggested strong product capability and growth potential for AI leaders. On the other, legal battles and wider regulatory scrutiny, like Anthropic's fight with the government and job cuts at Standard Chartered attributed in part to AI automation, highlighted political and operational risks.
So sentiment can swing fast depending on whether headlines emphasize capability or constraint.
Exactly. And public company contract access can be affected by private company legal outcomes, which makes the risk profile more complex.
Quick reaction. AI is powerful and messy.
Yeah, absolutely.
Okay, let's cover some practical indicators analysts suggested people watch going forward.
They recommended monitoring inflation pass-through metrics and energy inventories as early warning signs for policy changes. Also watch the term structure in treasuries. If long yields rise because real rates are higher, that implies a more persistent hit to growth equities than if yields just reflect near-term inflation.
And company-level stuff?
Track firms' exposure to energy cost changes, their margins, and pricing power. Some companies can pass costs to customers like Home Depot did, others can't, and that difference matters at the stock level.
Got it. A couple of short reactions before we wrap.
Markets closed up and down in different places. Mixed day.
Analysts still disagree on persistence.
Expect continued dispersion.
Before we sign off, a quick reminder. This is analysis for informational purposes only. We are not recommending buying, selling, or holding any security, and we're not giving personalized investment advice. Analysts note trends and data suggest certain pressures, but decisions are up to each listener.
Right. Objectively, yields and energy were the dominant macro story. AI and company-specific headlines added nuance. And the market finished the day with a mix of sector winners and losers.
So our clear takeaways today. 1. Rising long-term yields, just over 5% on the 30-year, tightened valuations for long-duration names. 2. Fed minutes showing energy cost pass-through raised the risk of stickier inflation. 3. AI headlines were a two-edged sword, talent and upgrades versus legal and regulatory risk. And 4. Expect high dispersion. Macro sets the backdrop, but idiosyncratic news will drive stock-level moves.
That's a good summary. If you're tracking markets, watch inflation data, treasury term moves, energy inventories, and corporate catalysts. Those will help tell which narrative takes control.
All right, thanks for walking through that with me.
My pleasure.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. We'll see you next time after the market closes.